Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRLA The Answer. And periodically, I like to do a market update whenever economic conditions require it. In the last 10 days, the stock market's been on a wild ride, and I want to take a few minutes and talk about that. Now, I do these videos primarily for my clients. So if you're a client of mine, I want to thank you for your business. Thank you for your trust. You know I don't take it lightly. If you're not a client of mine and you have any questions about anything I say, then don't hesitate to look us up, and feel free to schedule a quick 15-minute call with me. I'd be more than happy to talk to you. The best way to contact us is through our website at providencefinancialinc.com. And you can get all our contact information there. And while you're there, go to our YouTube channel and or our YouTube link. Just click on the link and follow us on YouTube, and then you'll get these videos automatically if you didn't get it from YouTube already. And if you're a client of mine, do the same thing. I think a lot of our clients still haven't followed us on YouTube. Click on the YouTube, follow us, Facebook. That's a great way to stay in touch with us. And as economic conditions unfold, I'll be doing videos like this to, to get the information out to our client base. So what's up with the market? The market has gone down 10%, a little more in the last 8 or 9 trading days here or so. And, a lot of people have a dilemma at this point. I can't tell you how many times I heard in 2017 from individuals, not really my clients, but from other individuals, people that are maybe considering becoming clients or people that I just talked to from my radio show or however they get in touch with us, that they want to wait. The stock market's doing so well in 2017, they just want to ride it out. And when the stock market starts to go down, then they're going to get out. Well, we're at the point now where the stock market's put you in a dilemma. What do you do at this point? I mean, we're down 10% from a record high that was on January 26th. We had a record high, and now we're down a little more than 10%. So is this the point where you get out? I don't know the answer to that question. I don't know where the market's going to go, if it's going to go down or going to go up. What I do know is that over the course of the last 4 years, there have been 4 times now, including just the last 10 days, there have been 4 times that the market has dropped by 10% in the course of around a week, only to bounce back. And every time so far, it's come back. It's come back. And I'm afraid that it's kind of created a false sense of security. I think there's a lot of people out there now saying, hey, this is a buying opportunity, get in. And the reason they're saying that is because every other time this has happened, it's been a buying opportunity. But the reality is it a buying opportunity now? Just because the market has come back before, I don't know that it means the market's going to, come back at this point. And yet I'm not saying it's not. I'm just saying we don't know. I think what's happened, though, is I think the market has, by doing this, dropping 10 point or 10% in a week or so and then coming back, I think it's created a false sense of security. And if you're 20 or 30, if we're wrong and the market does keep going down, then you can afford to ride it out. But if you're 50 or 60 years old and the market does keep going down, then there could be some problems ahead. And I think the market's being stretched. Every time the market has some issues like it's having now, I feel like it's being stretched like a rubber band. And, it's been stretched like this multiple times in the last 4 years, and then the pressure's been taken off. And then it's been stretched again, and then the pressure's been taken off. And then it was stretched a third time, and then pressure taken off. And now it's stretched again. Well, if you keep stretching a rubber band over and over again, what's going to happen? Eventually, that rubber band is going to break. And we all know that. And I almost feel like sometimes people think that this rubber band can't break. That the market's just going to go straight up. And it's funny, I know some people are thinking or being reminded that actually the market can go down at some point as well too. But we have to remember that it can actually go down a lot more than it has at this point. Now, if you're a client of mine, I just want to take a minute and put you at peace and remind you that for a while now, for 3 or 4 years, I've been projecting that we're going to have some major issues with the stock market ahead. And is this the start of that? I don't know. Don't hear me say this is what the start of it is. I don't know if we bounce back from this or if there's something bigger behind the scenes. But I think long term there's something bigger. I just don't know when that starts. I don't know how deep that's going to be. I don't know how long that's going to take. There's lots of things I don't know. But if you're a client of mine, remember, you're invested for income. You're invested for that consistent dividends and interest, and really positioned in such a way to where, you're conservative and not directly invested in the common stock market, which is what we're talking about here. And if you want a refresher of, being invested for growth or income like we have most of you invested, go back and watch my video for income I did about 2 weeks ago, talking about the difference between investing for growth or income. At our client appreciation event, a lot of you were there. I think we had 250 people or so up at the Odyssey in December of 2017. I gave about a 20-minute talk about that. That's on YouTube. You can go watch that. So you can watch these videos. But the bottom line is you're invested conservatively. Doesn't mean your portfolio is not going to fluctuate up and down, but you're invested for the income. It's not about the growth. Go back and watch those videos, and those will be a good refresher. But your portfolio is very conservative. Nothing to worry about because we've expected this. But the question is then, could we go down more from here? And the obvious answer to me is, of course we could. Now, again, whether this starts that or not, I don't know. But let's talk about a factor that is often considered in the Wall Street world to determine, where the market could go and how expensive the market is. Because oftentimes you hear this word overvalued. The market is overvalued and we're due for a correction. And a lot of times I talk with my clients that don't even know what that means. I had clients in my office earlier today, and we were talking about this, and I mentioned overvalued and PE ratio, and they said, "Yeah, I've heard about those terms. I don't really know what that means." And I want to take some time and explain what that means. When we talk about overvalued, we're talking about the price of the market being expensive relative to history, being expensive. And you have to look at it according to history. And the way that we value the markets is through a price to earnings ratio. It's what the price is of something for the amount of earnings. It's the price divided by the earnings. And that's all boiled down to a ratio that then tells us whether the price we pay is too expensive or not. And when you look at the price to earnings ratio, it just simplifies everything and lets us know whether what we're buying is expensive. So let me give you an example that I think just might make it real easy. Let's say that I own an ice cream shop, and you and I are friends, and you know that I make about $100,000 a year running my ice cream shop. Right? And one day I come to you, and I say, you know what? I have a dilemma. A guy came into my ice cream shop today, and he wrote me a check. He wants to buy my ice cream shop. And I hand you the check, and you look at the check, and you realize it's a check for $2 million. And you know I make only $100,000 a year on this ice cream shop. So let me ask you, if I handed you a check for $2 million and asked you, what should I do? Should I take this check and sell him my ice cream shop? Or should I turn it down? What would you tell me? Now, I have to tell you, it's not the first time I've asked this question. A lot of you watching this video have heard this question before. I've asked this question hundreds of times. And never once have I had anyone ever tell me that I should keep my ice cream shop. Why? Because $2 million is very expensive when the ice cream shop's only making $100,000 a year, right? Very expensive. And most of you would tell me, take the check and run. Don't walk to the bank. Run to the bank and go cash that check as fast as you can. Now, here's the thing. If you take that $2 million and you divide it by $100,000, that's 20. That's your price to earnings ratio. 20. PE ratio of 20 then is very expensive. Now, the nice thing about a price to earnings ratio is you just chop off all the zeros. It doesn't matter whether you have a $2 million price with $100,000 of earnings, or whether you have a $1 billion price with $50 million of earnings. The PE ratio of 20 is the same. So let me ask you, if you wouldn't buy my ice cream shop with a PE ratio of 20, would you buy a stock out there with a PE ratio of 20? A lot of you right now are saying probably not. And then the next fair question is, well, what is the PE ratio today? And what is the average PE ratio over time? Okay. Well, the average PE ratio over really any 10-year period is around 15. And it really depends on who you ask. I've looked at all the charts. I've read lots of articles. It depends on how you measure it. but it's around 15 over any 10-year period of time, around 15. So 20 is very expensive. So where are we at today? Well, today we are at around 24. Today, February 8th, after we just had a 1,000-point drop in the market and went over the 10% mark for the last 10 days in the stock market. Today we're at about 24. Prior to this drop, we were at 26. So the market's dropped 10%, but the PE ratio has only dropped by 2. What would it take for the PE ratios to get back in line with 15, with their 10-year average? About a 45% more drop. Now, I know some of you are looking at this going, okay, it's not going to happen. We've already had a 60% drop in '08. We already had a 50% drop in '01. Is it possible that we could have another 45% on top of this 10% that we are at now? It's possible. Am I saying it's going to happen? Absolutely not. Don't misunderstand me. All I'm saying is that we are still extremely overpriced. Is it a buying opportunity? I don't know. Here's what I know. What I do know is that if you are in the market and you've been waiting for time to get out, you're going to have to ask yourself the tough question. Is this the time? I can't answer that question for you. How much more can you afford to lose at this point? Because we're down 10%, or you're down 10% in the last 8, 9, 10 days. Do we want to go down another 10%? Do we want to gamble? This is the dilemma that the market puts us in. For my clients, you don't have this dilemma. And that's a nice place to be. If you have any questions about anything that I've said, don't hesitate to call me. You can get us through our website, providencefinancialinc.com. Again, click on YouTube, follow us. If you think maybe it is time to get out of the market, maybe it is time to get half out of the market, call me. Be more than happy to meet with you and help you do that. And if you want to stay and write it out, then feel free to do that. Once again, for my clients, thank you for your trust. Thank you for your business, and certainly look forward to talking to you down the road. God bless.